Gold is fundamentally misunderstood. And we think it's an opportunity today to revisit what really drives gold prices. Gold prices have topped out slightly above $1,900 an ounce back in 2011 and subsequently went through a multi-year consolidation phase, ranging mostly between $1,200 and $1,400 an ounce. The recent crisis was an opportunity for gold to shine again. Gold year to date is one of the best performing asset classes. Actually, we get questions as to why gold has not performed even stronger in light of the amount of money that is being printed by central banks, the size of the asset purchase. We've seen the balance sheet of the Federal Reserve move in no time from slightly less than 4 trillion to already more than 7 on its way to 9 or 10 trillion in the not too distant future. Gold is fundamentally misunderstood. And we think it's an opportunity today to revisit what really drives gold prices. Gold is a rather small asset class, about 1% of financial assets, bonds, and equities altogether. Gold has unique characteristics. Fundamentally, gold cannot be printed. Its supply is constrained, which gives some characteristic of a store of value. But the most precious characteristic about gold is the fact that it's the only financial asset that, when held in physical form, is not a claim against someone else. So when you buy a bond, you have a claim against the revenue of the firm that has issued the bond. When you buy an equity investment, you have a claim against the residual profit of that business. And therefore, there is counterparty risk. If the counterparty does not pay the promised distribution, your investment will be impaired. When systemic risk is rising, and we still have in memory what happened during the banking crisis in 2008, gold goes up strongly in value because it's one of the rare assets that doesn't have such counterparty risk characteristics. So it's a hedge against systemic risk. And of course, if central banks print too much money and inflation eventually picks up, gold will also, to a certain extent, hedge you against that inflation risk because it will be revalued when priced in dollar or euro or whatever currency is your reference point. What is happening today? As we said from the beginning, the response from central banks to the crisis was so comprehensive, so rapid, and so deep that systemic risk never had a chance to really wake up again. And very quickly, financial markets stabilized, were functioning properly. So the systemic risk angle to gold prices never kicked in. Meanwhile, yes, governments are coming up with a coordinated fiscal response of diverse nature, and we've explained many times that we have some concern in a few months' time about an increasingly heterogeneous economic recovery across countries. But so far, the risk remains tilted in our view towards deflation. So we're not at this point where inflation is around the corner, about to pick up significantly, and then the merits of gold as an inflation hedge would start to play out. Therefore, we think at the recent price of $1,700, in the short run, gold has fully priced the recession that the containment measure of the virus has provoked. The economy is slowly starting to recover. And for now, we think most of the gains on the gold price are behind us. We expect a phase of consolidation, And at a later stage, another leg up in the price of gold in the not too distant future.